If you've ever scrolled through your trading app and seen a stock under $5, you've probably thought, if this just doubles, I'm set. That dream of turning pocket change into profits is what pulls people into penny stocks. But here's the truth. Stocks are some of the riskiest investments you can make. They move fast, crash hard, and often belong to companies still trying to prove they can survive. Many rely on debt or constant share dilution just to stay afloat. Think of them as wild cards in your portfolio. Fun to trade, but never something to bet big on. Keep them as a small speculative slice, maybe 5 to 10% at most. All right, with that out of the way, let's break down 3 stocks to watch heading into 2025, each with serious upside potential and big risks you need to know. Stock deep dives. Let's go in. 1. AMC Entertainment, ticker AMC. You probably remember AMC as the original meme stock. Back in 2021, it became the face of retail investing power surging as everyday investors fought back against Wall Street's short sellers. But in 2025, AMC's story isn't about memes anymore. It's about survival and slow recovery. The good news? The box office is making a comeback. AMC's Q2 2025 earnings beat expectations, with revenue up more than 26% year over year thanks to better attendance and stronger film releases. People are returning to theaters, and AMC is working hard to give them more reasons to come back. The company is also reinventing itself beyond movies. It's been hosting live sports events, concerts, and even gaming showcases, turning theaters into multi-purpose entertainment hubs. These experiments show AMC's willingness to evolve in a streaming-heavy world. But the biggest shadow still hanging over AMC is debt. The company's heavy borrowing and repeated share dilution have made it hard for the stock to regain momentum. Even with improving fundamentals, AMC remains far below its meme-era highs. Bottom line, AMC isn't a get-rich story anymore. It's a turnaround play tied to the broader entertainment rebound. For investors who still believe theaters have a place in modern entertainment, AMC offers speculative upside. For everyone else, it's a name to watch from a safe distance. Next up, let's shift gears to Southeast Asia, where Grab Holdings, ticker Grab, last traded at around $5.86 and is building something far bigger than a comeback story. Grab isn't trying to recover, it's trying to dominate. If you've ever used Uber, DoorDash, or Venmo, imagine all of that rolled into one app. That's Grab, Southeast Asia's leading super app, offering ride-hailing, food delivery, digital payments, and financial services across countries like Singapore, Malaysia, and Vietnam. What's fueling the excitement is that Grab finally hit profitability. After years of aggressive expansion, the company posted a 23% year-over-year revenue increase in Q2 2025, with quarterly revenue around $819 million. That's a major milestone for a tech company once known for endless spending. And yet, the stock trades for less than half of its 2021 SPAC valuation, even though its revenue has more than quadrupled since then. Investors see that as a potential opportunity gap. Grab's biggest edge lies in its ecosystem. Millions of people in Southeast Asia are just beginning to use digital financial tools, and Grab already has the infrastructure, users, and brand trust to capture that growth. Still, there are real risks. The company faces fierce local competition, regulatory hurdles, and thin margins in delivery and fintech. Emerging markets also add volatility, currency swings, uneven growth, and evolving laws. In short, Grab isn't a recovery play like AMC. It's a growth engine in one of the fastest expanding digital economies in the world. For risk-tolerant investors, it's a bet on the future of Southeast Asia's tech scene rather than a rebound from the past. Nokia, ticker NOK. And finally, let's talk about Nokia. The same company that once dominated mobile phones is now quietly rebuilding itself as a global player in 5G infrastructure and network technology. At first glance, Nokia doesn't sound like a high-risk, high-reward play, but here's why it's getting attention again. Beside trading under $5, Nokia is profitable, generates consistent free cash flow, and holds strong contracts with major telecom operators worldwide. The stock has been beaten down over the past year due to slower 5G rollouts and weaker demand in Europe and North America. But analysts say that much of the bad news is already priced in. With global 5G adoption still expanding and new deals in India, the Middle East, and Africa, Nokia could see a revenue rebound through 2025. It's also cutting costs aggressively and focusing more on AI-driven network automation, a move that could improve margins over time. The risk? growth may stay sluggish until telecom capital spending picks up again. This isn't a momentum stock, it's a patience play. Bottom line, Nokia trades like a forgotten name, but underneath, it's a stable company with cash flow, a solid balance sheet, and exposure to a long-term tech trend. For investors looking for a sub-$5 stock with real business fundamentals, this one deserves a spot on the watch list. How to research and approach these stocks. Now that we've covered the names, let's talk strategy. How should you actually approach stocks like these? If you're serious about trading or investing in low-priced names, research is everything. Start with your own homework. Read the company's earning reports, SEC filings, and press releases. Look for real progress, not just hype on social media. If the only thing pushing the price online is buzz, that's a warning sign. Next, understand the business model. Ask yourself, does this company have a clear way of making money? If it takes 10 minutes to figure out how they generate revenue, that's usually a red flag. Simplicity and transparency matter. Then, check financial health. Look closely at revenue growth, profit margins, and especially debt levels. A company drowning in debt can look cheap on paper, but quickly turn into a value trap. Keep an eye on dilution, too. Many penny stocks raise capital by issuing new shares, which weakens the value of existing ones. If the share count keeps climbing year after year, that's a sign management might be funding operations at your expense. You should also think long-term. Speculative plays need time to develop, and not every story pans out right away. Be patient, but realistic. Some of these companies never make it. Most importantly, protect yourself. Use stop losses or set strict position limits. Never let one risky trade take down your portfolio. For most investors, keeping speculative names to just 5 to 10% of total holdings is more than enough. And finally, stay objective. It's easy to fall in love with a stock you've researched for weeks, but the market doesn't care about emotions. If the fundamentals change, be ready to cut your losses and move on. Conclusion and final warning. So to wrap it up, here's the quick recap. We looked at 3 stocks under $5. AMC Entertainment, AMC, Grab Holdings, Grab, Nokia, and OK. A cash flow machine facing stiff competition but trading at bargain prices. Each of these has potential, but they also come with serious risk. And that's the real message here. Low price doesn't mean low risk. Just because a stock trades doesn't mean it's cheap. Sometimes it's priced that way for a reason. But if you understand the risks, manage your position size, and do your research, you can use these kind of stocks to add a little high-risk, high-reward exposure to your portfolio. Think of it like seasoning. A little can add flavor, but too much can ruin the dish. If you found this breakdown helpful, hit that like button, drop a comment with your favorite stock, and subscribe to Elite Trade Club for more deep dives into high-risk, high-reward investing ideas. Stay smart, stay curious, and as always, invest wisely.